Well, good afternoon, everyone, and a very warm welcome to this webinar that we're going to be hosting today with guest speakers from Smith & Williamson. We've been talking for a while about doing a joint webinar as part of our support to clients during the COVID crisis, and wanted to bring together financial and legal brains to talk about some practical issues that will hopefully be of interest to everyone at the moment on how to optimize your cash flow through the crisis and beyond the other side. So a very warm welcome to Mark Benker and Alistair Shaw from Smith & Williamson. Mark is a partner in the transaction services team, and Alistair is a partner in the business tax services team. And also warm welcome to my colleague Michelle Sheen, who is a partner from our financial markets and products team, who is a restructuring specialist, or when she's feeling particularly optimistic, calls herself an insolvency specialist, who we've got on hand today. We decided we had quite a lot of material when we started talking about putting this webinar together, so decided to split it into two separate sessions. One today, when we'll be talking for just under half an hour, and then we'll hand over to you, our guests, with the ability, you've got a chat function in the webinar software, a Q&A function rather. If you have any questions as you go, do please feel to populate that section. We can see those questions and we'll either take them as they come, or we'll save them for a Q&A for 15 minutes at the end. And then once this session has been recorded, we'll share the recording with all of you in due course. And then on Thursday, same time on Thursday, we'll have the separate second session where we'll continue the discussion. So with that as an introduction, Michelle, can I hand over to you to talk about the solvency aspects, just to set the scene in terms of giving us a very brief understanding of the backdrop of UK solvency law and how that might impact on cash flows for companies. And just before we do that, Chloe, we wanted to do some live polling today just to get people used to the functionality of the webinar. Chloe, could I ask you to pull up the first live poll? That's great, thank you. So just to give us a flavour of where clients are and people that have dialed in today, our understanding is that growth companies are looking at their cash flows very closely. We just wanted to get an idea of where you think you are in terms of visibility at the moment. How far ahead do you have cash flow visibility? Is it A, less than 3 months, B, 3 to 6 months, and C, longer than 6 months? Responses to this will all be anonymous, but I think it'll hopefully give us a flavour of where people are in the room. We can obviously share this with you in due course as part of the recording.
Okay, so as Tim has said, this webinar is about optimising cash flow. And certainly I don't believe, as an insolvency lawyer, that you can discuss cash flow without understanding the definition of insolvency. So under the Insolvency Act 1986, there's two types of insolvency. There's balance sheet insolvency, pursuant to which liabilities outweigh assets, and then there's cash flow insolvency, which is an inability to pay debts as they fall due. It's cash flow insolvency which generally causes more of the problems, as this is creditor driven. They can decide to make demand on you for repayment. They can issue winding up petitions. So what we're going to look at today is the best way of extending the cash flow runway, and also what investment and debt opportunities are available to stressed companies. I do believe that in order to assess what your best runway is, if you're dealing with a stressed or a distressed business, it's important to know where you are on what I've termed there the distress curve. The higher up the distress curve you are in terms of time, the more options you have available. And obviously the less time, the fewer options you have. So the more time you've got, you can look at shareholder or other investor borrowing, or equity injection, you could enter into discussions with your existing lender, probably on more favourable terms than you would be able to had you got less time available. Obviously, the less time available, which in my experience is generally when people come to us, inevitably you will probably be insolvent or verging on the edge of insolvency, and the only options you have left might be administration or liquidation. So also where you are in terms of time will dictate to whom directors' duties erode. So if you are insolvent, duties erode to creditors rather than shareholders, and that brings into play certain other problems under the Insolvency Act, for example, wrongful trading. So I'll pass over to Tim now, who I think is going to do another live poll, followed by Mark, who will take us through cash flow.
Thank you, Michelle. That's great. So yes, Chloe, if you could just pop up the second live poll, just getting a feel for where people are in their fundraising activity at the moment. Are you expecting to raise largely from existing investors, new investors, or both for your next fundraising? We'll just give you a few minutes to respond to that. And then, as Michelle said, we'll hand over to Mark to talk about cash flows.
Good afternoon, everybody. It's good to be here. Just a bit of more background on me. So I spend most of my time with financial sponsors looking to acquire businesses, so lower mid-market private equity or venture capital, and helping them through the due diligence process, providing SPA advice and the like around their transactions. So quite a lot of these observations are from talking to those funds and understanding what they've been doing through the crisis and what they are planning on doing as we try to emerge from the crisis over the next 3, 6 to 9 months. So I think obviously over 12 weeks into the lockdown now, and it's probably just worth reflecting on how businesses have coped. Clearly a huge variation depending on what sector that business is in, but to a large extent, companies have followed the mantra around cash is king. And actually they've managed liquidity really quite well. There has been lots of options available, all very helpful from the government, bounce back loans, the future fund, CBILS, and only really the latter providing some challenges around obtaining it. On top of that, the banks have been relatively accommodating, certainly versus previous financial crises. They've tried to help where they can. And companies obviously focused on the cost base. They manage that as best they can through furloughing staff, reducing discretionary spend, any other advantages the government might provide, really to try and reduce that burn rate to a minimum. One observation also to have from funds and how they've assisted their portfolio companies, they've all pretty much, without exception, set up forums for their management teams to congregate, for the CFOs to CEOs to share their ideas, share best practice on how to cope through this process. It also highlighted the good management teams, the strong management teams from the ordinary. The good ones have been proactive, they've taken decisions quickly, they've communicated thoroughly through the company themselves and to external stakeholders. So the liquidity that's been made available has been actually quite remarkable. So people have been quite surprised how much they've been able to gather. The key question is clearly what happens now over the next 3 to 6 to 9 months when companies are weaned off this government support. So the ending of the furlough, the rates holidays, VAT becomes due, etc. And then there is a need to rebuild, and that requires investment to open up, to ready operations, to invest in marketing, invest in working capital. So not surprisingly, I'm hearing quite a lot of funds saying that the pain is yet to come, unfortunately. And it's worth noting that restructuring teams, including ours at Smith & Williamson and other firms and lawyers as well, are gearing up for a relatively busy Q4. And just to sort of echo a point that Michelle raised, I think the number of times that my restructuring colleagues have said, if they had brought us in earlier, we might have been able to do something.
And Mark, To what extent are you seeing that being a sort of sectorized approach? Are you anticipating that some sectors are going to be very differently impacted than others?
I think that is right. I think to some sectors there's more opportunity, and other sectors they're still going to be focusing on the downside and how to manage their way through. So I think also it'd be interesting to see to what extent companies are seeing potential fundraisers as being for opportunities that arise versus a defensive approach to things. So companies that, largely, whatever state you're in, I think there's still a huge focus on the forecasting and modelling. So we're seeing companies continuing to do scenario planning, and it's clear that sort of there's only limited amount of visibility at the moment. Customers are beginning to talk to suppliers about how to open up. This is even ahead of sort of some government announcements for certain sectors. And companies are trying to work out what their demand looks like, what the operational limitations. But visibility is growing week by week. So I think it's even more critical now to have a robust, fully integrated model that can be easily manipulated to run these scenarios. Short-term or 13-week cash flow planning forecasting is also critical. This should really be on a direct basis, receipts and payments. It gives the best picture of what the future cash flow looks like. It's worth noting, I think, that the forecasting and scenario planning for this next phase is much more complex than it was going into the downturn. As we went in, there were a limited number of options. You understood revenue quite quickly, and it's really to sort of cut down on costs and cash flow as best you can. Now, I think as we come out, the opportunities are much greater, not quite infinite, but there are opportunities out there, certainly in certain sectors. So how hard you push on certain areas, you're going to want to run some options around that.
Mark, are you finding, sorry to interrupt, are you finding that you're being brought in by clients now to help bolster their finance function internally?
We certainly see some companies with not quite the capabilities or resource to run the forecasting and modelling scenarios. I think before they were able to cope with a relatively straightforward approach, particularly if they had lots of funds. Now it's all a bit tighter, and I think a proper model does yield dividends further down the line. I think also I'd note that investors are now looking forward as they're seeing their due diligence, they're seeing scenario planning as being a much greater part of their work and understanding the business. So that's going to be key going forward as well. So the other sort of three areas of focus that we're seeing companies spend time on is obviously updating their strategy. Where are your strengths? Where are you going to go and focus on? What are those new opportunities? And the other areas are resetting the cost structure, refining that. As the lockdown lifts, companies need to make decisions on where to spend, where not to spend. Alistair will talk about this in more detail in a minute. And then the third thing is really optimizing working capital. So I think in all of these, as I mentioned before, the good management teams are spending time with their people, involving their teams and talking to their customers and suppliers. And I think that's going to become increasingly important as we all try and come out of the lockdown. So I'll hand over to Alistair, who will talk through the cost opportunities.
Thanks, Mark.
Thanks, Mark. Yeah, so very quickly, so I'm a tax partner at S&W, and much of my work is focused on fast-growing private equity or privately owned businesses. Much of that has an international element to it as well. Just before I get onto the cost reduction and cash flow management, and it's probably not one of your questions, Tim, it has been very varied when I look at my client base and other clients I've been speaking to, in terms of some businesses literally in hibernation, really, really sad. Some businesses, they're not too badly impacted at the minute, and they're still really driving forward. And a lot of those are seeking international growth or coming into the UK, and then some which are positively impacted, which is good to see and really positive for everyone. But what I would say across all of those different types of clients, I think all of them seem to be employing some sort of cost reduction strategy, and that goes right to the top of the business, the CEO, CFO level. We're seeing very strict approval processes. Even some of our largest clients, we're seeing a process on one of them where everything has to go for any discretionary spend, anything that's not been committed to already has to go to CEO. So even speaking to the CFO, he's saying to me, every one of his professional fees or professional costs has to have CEO approval. That seems fairly consistent across many, if not all, businesses at the minute. We're seeing any discretionary spend being put on hold, pretty much. And arguably much of this discretionary spend you couldn't spend at the minute. You know, if I look at our own business, our travel costs, our entertainment, our BD, everything is massively reduced. And you can see that being the case for at least the medium term. I think what's going to be quite interesting as we come out of this, though, is how businesses then adapt. So I look at our own business again. So we had our tax conference last Friday. Normally we have to hire a venue somewhere. We have people coming from across the country to that venue. You know, we've got travel costs, we've got accommodation, we've got meal costs. It's quite an expensive affair for one day, but obviously it's something good and something we do for the whole team, and it generates real benefits. Our conference on Friday was half a day virtual conference on Zoom, I think it was. The feedback we've actually had so far has been incredibly positive, and it does pose a question actually going forward, and certainly in the medium term, I think we'd do that again. A clear cost benefit, and obviously if we're going to get just the same benefit from it, I guess the only thing you don't get is that networking. To state the obvious, office space. Many of our clients are already thinking about what they're going to do going forward if their leases have come to an end. I've got a few clients who have closed some offices, and for now everyone's working virtually from home to decide what they're going to do in the future. And if they're fortunate to be in that position, they're very happy because they don't have that fixed cost which many of us have at the minute. So again, we all know that's going to be something that changes and represents an opportunity to cost reduction going forward. From a people perspective, unless you are in the minority, I guess, of businesses which is growing. So I've got one pharmaceutical business I work with who are growing really quickly at the minute, who are actively recruiting. For most businesses, there's some sort of recruitment freeze at the minute. Only exceptional recruitment of individuals that are really needed are getting approved. And again, those are going right to the CEO level to get that approval. Consequently, we're seeing many of our clients use more contractors, or using ours or lawyers or other services to second staff. Now, these secondments are generally for a short period of time to sort of patch over an urgent need in that business, but we've seen quite a spike in that service that we've seen, and also the use of contractors.
Yeah, it's interesting that one though, isn't it? Because I think contractors tend to be more expensive in the short term than people on a full-time basis. But it does seem to be the way that a lot of people are now going for a much more short-termist approach, and I sort of wonder whether we'll start to see a change to that as time goes on.
Yeah, no, I completely agree.
We've got no ability to forecast. We've only got one quarter under our belts, and it's difficult to extrapolate from that going forwards as to what the cash flows are going to look like in due course.
I mean, more generally from a people cost perspective, we've seen, again, on a number of businesses, salary sacrifice, salary reduction, whether that be a 4-day week or some sort of mechanism to reduce costs. And actually, for many businesses I speak to, they're not that adversely impacted yet, but they're fearful of what might happen in the future. So they're already really sort of prioritising managing their cash flow and thinking about their people sort of costs. And generally, that's been quite well received, I've seen amongst my client base. I'm not going to go into too much. Everyone knows about the furlough regime. For all of our clients, it's been very relevant, even if they haven't applied it before, as to whether they need to apply the furlough scheme. This changes from the 1st of July onwards, as everyone would have read. I think a few points just to note there. From the 1st of July, you can have part-time employees coming back. So that's great, and it provides a lot of flexibility that many businesses were hoping for. It does probably mean some of the calculations and some of the work to make the claims is going to be more complicated. From August, there's going to be a cost to businesses. So in August, it's just the employer's NIC and the pension contributions, but then September and October, we see some contributions, so 10% in September, 20% in October, where employers will need to contribute. One thing HMRC, there's some new guidance and points they made, I think it was only yesterday or maybe back end of last week. We're getting the message they're going to police this quite hard. So They're asking people to retain their records for 6 years. We do expect a lot of scrutiny. They're also saying, though, which is positive, and I think resonates with what we're seeing from our clients, there's going to be an opportunity to update your calculations and provide a true up. So the calculations are quite complicated, they're getting more complicated, and I know speaking to our sort of furlough employment tax specialists, they're seeing a lot of calculations done by our clients which are incorrect or have some sort of errors. So you might be overclaiming, but perversely you might be underclaiming. So again, it's really worth getting into those calculations, particularly as they get more complicated, to see if there might be an opportunity here.
And are you seeing HMRC being quite practical at the moment in terms of how they approach the furlough requests from clients? So although they may come back with some additional scrutiny in due course, up front they're being helpful?
Yeah, incredibly helpful. I have to admit, when the furlough scheme has been implemented, I think we were all fearful as to how quickly this cash will come in and whether it would come in quick enough. We saw claims even for very large companies being done in a number of days. So that was great. I think they're just processing. I don't think they're reviewing at all, but I think that scrutiny will come in due course. And to be fair to you, I mean, that's what we've seen across all taxes, whether that be sort of deferring tax payments, R&D claims, you know, any sort of tax referrals, tax incentives. HMRC, in my experience, have been pretty good. There were real challenges and remain some challenges around actually physically speaking to HMRC. You might have to queue, but when you do manage to speak with them, they understand. And where in the past, in normal circumstances, they expect to see quite a bit of evidence to support, let's say, a deferral or a claim, and now they get the situation, they get it's down to COVID, and they'll generally agree something quite quickly. So if we just move on to the next, so one last point on this slide was around redundancies. Now, many of our clients are now thinking about what they do. I do think when I talk to my client base, you know, no one wants to make any redundancies, but given the cost of furlough and dependent on the industry, you know, if you're in a hospitality or catering industry, it's very hard to retain your staff if your revenues are close to zero. So again, businesses are starting to actually, unfortunately, think about redundancies, and we're seeing this in the press on an almost daily basis now as well. In terms of optimising cash flow, Mark covered briefly the government-backed loans, and I think this was quite slow to start off with, particularly with the civils, but again, we've seen a lot of our business and our clients utilise these government-backed loans, which have been a real sort of godsend to those businesses. From a tax deferral and claims perspective, again, as I mentioned before, HMRC have been great. They really have in terms of agreeing deferrals. I guess the concern is now is what's going to happen when the deferrals run out. So from that perspective, I'm sure everyone will recall, but the deferral for March payments goes until March next year. So everyone's going to have to pay their VAT March next year. We've not heard, and again, it's not saying it's not going to happen, but we've not heard, or we don't expect any subsequent deferrals to come about from that perspective. That said, we still have the flexibility around time to pay. So if you are in a position that you don't think you're going to be able to meet your next VAT liability, then it's certainly worth speaking to HMRC. I think they'll be fair and reasonable. That's what we're seeing. But again, I think what we're finding now is you need to apply a bit more scrutiny and a bit more evidence to why you want to defer these payments. From a PAYE perspective, again, lots of flexibility, and the deferments are typically for 3 months in terms of your income tax and national insurance contributions. We're continuing to see flexibility. HMRC's view is that actually this is only a 3-month deferral, and it's a 3-month deferral on the basis that you make payments for all other obligations on a timely basis. That said, we have seen some flexibility where you're in a hospitality or an industry which is particularly hard hit and you can't go back to work. So again, there remains flexibility there, but like the other deferrals, the challenge we're going to have is these things are going to come back to bite us in the coming months when you've got your current month liabilities plus your repayments for VAT and PAYE from earlier months. From a corporation tax perspective, we've seen, again, flexibility in terms of deferring payments where corporation tax has been due, whether that's quarterly instalments or for smaller businesses where it's due 9 months after the year end. And I expect to continue to see that flexibility from HMRC. What we're going to start seeing, and we're already seeing some businesses, is that they're looking to finish up their books, to get their accounts done and get the tax computations done as soon as possible so they can make some loss carryback claims. So many of our clients have had a really good 2018 or parts of 2019, but they're now in a loss-making position. So if you can carry back your losses from the current year to the prior year and get any tax back from revenue, and an obvious opportunity to do so. And in doing so, it's worth getting your advisor to really kick the tires around any claims, elections, things available in your tax returns to increase that loss in the current year to carry it back. It goes without saying, we're seeing a huge amount of interest in our R&D business. So looking at any claims that can be made, either where a company may not have previously made an R&D tax claim, or they've made one already, but we're seeing us and other providers really kick the tires to see if there's any opportunity to maximise those claims. The great thing with R&D, you can do your current year and prior year claims.
Yeah, exactly, you can go backwards. And how long do those claims take to come to fruition normally?
So again, all praise to HMRC. Currently, they're generally just processing them. So we're seeing the R&D claims being processed in a number of weeks. So sometimes 2, 3, 4 weeks from when the claim is submitted, we're seeing the cash back. Again, I expect to see further scrutiny in the future. But again, HMRC are being really, really good in terms of processing those claims.
I mean, I think that really is quite an important one to look at, because it's probably the one area that we see as part of either a fundraising or probably more prevalently an exit scenario, where due diligence is being carried out and people start to look quite closely at R&D tax credits, and some clients on the sell side might be looking to say, well, look, when that comes through, we'd like to have that cash, please, as part of an adjustment. Our experience has generally been that clients are not overly they're quite cautious in their approach to R&D tax credits generally, and don't exaggerate them or push them too far. So it wouldn't surprise me if people find that they have invested far more in R&D than they might have anticipated.
Yeah, no, absolutely, Tim. I think more often than not, when we, and I'm sure other advisors as well, pick up a legacy R&D claim, if you ask the right questions, quite often there's an opportunity to expand that claim. And we're not talking about aggressive claims here, we're just talking where there's expenditure that qualifies. And we all know that it's likely to be, particularly for the types of clients that I'm sure are listening now, PE-backed business is going to be a transaction at some point in the future. You don't want aggressive tax claims. But again, legitimate claims, we're seeing lots of them, and a clear opportunity to get some cash back to the business. And then lastly, just to cover off alternative remuneration, and I think we saw quite a bit of this back in 2008 and 2009. So the first point I just want to cover here. So a good example, they're probably going to be more senior employees, and if you're strapped for cash, is there an opportunity to reduce their salary, but in return provide them some sort of equity? Again, they get the equity when the price is perhaps lower. They've got the future growth, and clearly there's tax benefits if that falls within an EMI or some other sort of capital gains scheme, as opposed to being subject to income tax at a 45% rate, for example. So a good opportunity there. The one thing I would say is things have moved on a little bit from 2008 and 2009. Back then, you could swap your compensation for equity, and it would still fall within capital gains tax rules. Now there's some anti-avoidance which comes in, which means it may be captured and may be treated as a normal salary and therefore taxed, and that's almost a worst case scenario, because you've got no value.
You're going to have to pay up front.
The key point there is to provide an option. So instead of providing the equity, you provide the option. And again, if it's an EMI option, that can be really, really attractive. So certainly worth thinking about if you're in the position. Clearly, the downside is you're going to give away potentially some equity in the business, but in terms of getting through these difficult times, we're having quite a few conversations with businesses around that. And then just the final point for me is many of senior management, particularly PE-backed businesses, their sweet equity, their interest in the business is going to be underwater at the minute. So there's an opportunity to reset that management equity or consider other options to try and really incentivise those senior individuals, particularly if they're going to be key to the business going forward. So I know this is an area we're sort of looking at the minute, and have potentially some quite exciting opportunities for sort of senior people to get in at this right time. And I think from a PE house and from a shareholder perspective, you want to really incentivise these key individuals to drive them forward. And at the minute, there might be little incentivisation given where the business stands. So all of those areas we've been spoken for a while. This is just a snapshot of what we're seeing.
That's really helpful. Thank you, Alistair. And just with that last point, if you are looking at resetting the valuation for management equity, is that something that you have to put in place a new scheme, or can you effectively speak to HMRC and reset the base level for those options or shares which are currently in place?
Well, there's a number of different opportunities, and potentially some of it is linked to actually the shareholder debt coming in as well. That's quite an exciting opportunity we're looking at the minute, or it might be looking at the original schemes. I have to confess I'm not an expert in this area, and I know some of our brightest thinkers are looking at this at the minute. So
I know that team's quite busy at the moment.
Exactly.
Yeah, I mean the interesting thing there again, we time after time we say it would be great if people could come to us sooner. But if you are contemplating a fundraising or an exit in due course and haven't looked at management equity as part of that, it really is a good time to look at agreeing a low base value for the business in the hope there's going to be a bit of a bounce before an eventual exit. So that is something which is definitely worth spending some time getting right. And clients always see some reward in terms of their employees feeling much more incentivized and part of the business.
So with that, I'm just going to pass back to Mark, who's got a few points around working capital.
Thanks, Alistair.
So next
slide, Chloe, please. Thanks very much. So, I mean, working capital, obviously, the dynamics of that have been hit quite hard, all aspects of it, really. So the changes in customer payment behaviours, that's clearly affected when you're going to get the money in. And then you can also look at sort of what can you do with suppliers? Can you yourself agree some payment holidays if needed? Clearly, inventory levels, if you have it, have been affected. Often there's excess inventory on the books, and how do you manage that? So what we are seeing companies do is review their suppliers and their customers in quite a lot of detail and on a continuous basis. And in that review of suppliers, who are the ones that we who are going to continue are going to be fine, but actually who will need support and who's seriously struggling that you might actually look to try and help fund them to some degree. We're also looking a bit more of a sort of strategic approach to suppliers in terms of what you call supplier resilience. So removing kind of single points of failure, where you've just got a single supplier, and maybe changing it to multiple suppliers to deal with that. I'd observe also, I think modeling and forecasting working capital, even in easy times, is not normally done that well. It's normally quite complex. So given this is even more important, you've got to overlay these challenges on top of this. It's an area that does require some focus if you're going to get it right. And as you grow out of it, as we said, there's going to be quite a heavy demand on cash anyway. So forecasting this right is going to be key, and businesses really do need to focus on it. So I'll finish there on that point and then hand over to Tim.
Thank you, Mark. We're running slightly over time as expected, so I'm going to drop the third poll and just move to my section. Thank you, Chloe. I'm Tim Bird. I'm a partner in the corporate team at Phil Fisher and work on quite a lot of fundraisings at all series up to, but not including IPO, as well as on the M&A side. So I'm seeing both sides of the equation, both clients that have a portfolio of investee companies, as well as acting for the companies in some cases, going through the fundraising rounds. And I think what we are seeing, and it's been quite pleasing to see, is a much more collaborative approach between shareholders and portfolio companies to try and keep those companies on the straight and narrow at the moment. But what I wanted to talk about was just to give a quick run through some of the really critical issues to think about when fundraising. I think it's been really helpful hearing from you, Mark and Alistair, about immediate things that companies can do to improve their cash flow, both in terms of reducing expenditure, but also to see if there are other obvious and immediate ways of getting in fresh cash from grants, government sources, potentially from reduction of staff costs, etc. But ultimately, even before the current pandemic, there were a lot of SME companies in the UK that are sort of in growth sectors that were looking and contemplating fundraising. And I think a lot of those fundraisings have now been put on hold temporarily. We've seen a considerable amount of activity in the life science space, as you might anticipate, and also in digital health sectors. But those companies that have put fundraisings on hold have been largely firefighting, I think, in the background, and are now 12 weeks in, as you said, looking back at when they should be thinking about fundraising. The challenge we have is fundraisings always take way longer than anyone ever anticipates. And I think if we could just move quickly to the next slide, Chloe. I've got a slightly exaggerated timeline here, but and people always sigh when I say that fundraising can take up to 6 months, but we're almost, it's very rarely a 1 to 3 month window or runway, and it's almost always a 3 to 6 months from the get-go. So what I would say to clients and companies thinking about doing another fundraising is you need to get that process underway quickly, and there's quite a lot that you can do to get your ducks in a row, so that if you haven't quite made the decision, when you do press the button, you'll save yourself a lot of time in the early phase. So, you know, get yourself a data room. If you haven't already used one in the past, there's absolutely no reason why you shouldn't set up a data room, logically ordering all of your contracts, from your employment contracts, your corporate analysis, your disputes side, your real estate documentation. If you get all of that in order now, at the point at which you start, it's not going to be something that you're scrabbling around in the background. And particularly when people are working from home, I think there's going to be a far greater challenge getting your hands on documentation from your server. So that's something that you can easily do now in the background. Next stage, you know, getting advisors lined up. Again, just that process can take its time. If you haven't been through an equity fundraising before, so reach out early and get the right team in place, including insolvency practitioners. And I think Michelle, we didn't get a chance to talk with you about when it's best to, or if it's wise to, involve insolvency practitioners in a fundraising process. But my experience working with you is it doesn't need to be quite as scary as you think, just because it's got the word insolvency in the title.
No, absolutely. And very often in the accountancy firms, there's a crossover between corporate finance and restructuring anyway. So depending on where you are as a company, whether you're just stressed or you're distressed, I wouldn't necessarily sort of flaunt your insolvency practitioner when you're doing a fundraising. But if you are stressed, it's always a good idea to take as much advice as you can from anyone who can give you advice. Because I think if you are stressed or distressed, certainly in my experience, when you're going through a fundraising, I'd say 50% of the time they're not successful, and you do have to have some kind of contingency plan. And especially, as you've said, Tim, if it takes far longer than you think it's going to take, you've actually got to work out what your duties are and your cash flow runway to make sure that you can actually get to the end of the process.
Exactly. No, thanks for that. So during the first month, those companies that have already done a fundraising historically and may have institutional shareholders in their cap table, it's quite likely that you're going to need to get shareholder consent before you launch anything. So do have a think about that. Make sure that you're in regular contact as a board and not just having behind the scenes conversations between CEO and FD. Make sure that you engage with your wider board and have their backing to be starting the process looking at a fundraising. You'll be surprised, hopefully, in most cases, if you've got institutional shareholders, how helpful they can be if you push them. I know a lot of them will sell. A lot of VCs will say that they can be helpful with their network but it's relatively rare to actually use that network. And I'd suggest that now is the time to have that conversation with VC investors and see who they can be introducing you to. In terms of the documentation that you're going to need, this is where, I mean, I've condensed this first month really, and I think the reality is, once you've made the decision, it almost always takes longer to get your initial documentation in a row and start the process of talking to investors. But you should be working on your investment memorandum, or at least your pitch slide deck, and that's something that you can really be practicing right now to get ready for talking to investors. We haven't really touched on it today, and we're going to, I think, dwell on this much more in the second session, Mark and Alistair. But how important is getting your valuation right at the stage before you start approaching investors?
I think that's right. I mean, valuation is very difficult at the moment, so it's probably worth observing. Most people would recognise there's quite a disparity between views on valuation if you're the buyer or the investor or the seller. So I think the earlier you can start on it, the better. But as time goes on, as we get greater visibility, then that gap in the difference in valuation, which should narrow, as it's going to take a number of months to get there, we should have greater visibility, and that should shrink. So I think right now it's difficult for as of today, kind of how do you value a company unless it's relatively unaffected or positively affected. So the sooner you can start, the better.
I think that's right, Mark. So that's why I've sort of allowed a couple of months for what I've just called pitching, but actually you're not really going to be pitching. It's going to be an iterative process. And what we are seeing is that a number of companies come to us and say, we're ready to start a fundraising. We've got some investors lined up, and then it goes silent for quite a while. And what they're saying when I come back to them is, well, we are having positive conversations, but on this valuation point, we're trying to reach an understanding with a potential investor as to what our true valuation should be, particularly when you've got a series of historical and growing investment rounds going through the series previously. It's always hard to take a down round. So I think there's going to be a lot more time taken at the moment, scrutinizing working capital, cash flow, the financial position, before investors will agree to make an investment. So I do think that this initial phase is going to take a little bit longer before you actually get a term sheet. And then, of course, once you've got the term sheet, you've got to turn that into long form documentation. And I think one of the things that we're seeing, certainly in M&A, possibly less so in fundraisings, but we're seeing a lot more scrutiny during the due diligence process, and warranty discussions that are looking a lot harder than they were. Anecdotally, we're seeing that underwriters in warranty and indemnity insurance policies are asking for enhanced due diligence on any areas of the business that could be COVID impacted. And therefore you should expect a degree of scrutiny that you might not have had to go through in past fundraisings. So that's broadly it from me. I think I would allow yourselves a 6-month runway if you are doing a fundraising afresh. Obviously, if you have supportive shareholders in your cap table, I think a lot of companies are just simply going to go back to those shareholders rather than having to negotiate documentation from scratch and just add a little bit in. They might find one or two of them will put a convertible loan note in rather than having to renegotiate equity documents, and that possibly allows you to do things a little bit quicker, and also to agree that there'll be a discount at the next fundraising, so it sort of kicks the can down the street a little bit further. But of course, the question about down rounds that I had on my previous slide, one of the challenges is going to be that if you've got financial investors in your cap table, the likelihood is that there will be anti-dilution protection in place, and this is when founders really find what that means. If you have to do an investment round at a lower valuation than the previous one, that anti-dilution protection means that the dilution that will be suffered as a result of issuing shares at a lower price will largely be suffered by the founders. So definitely worth contemplating that before you have to do it. So that's it from us. Has anyone got any questions out there? I haven't seen any, so I've sort of been asking questions as we go. Do feel free to send through questions as I'm talking. We've got a couple more minutes before we'll wrap up. And then just to give you advance notice of what we plan talking about on the next webinar on Thursday, on the second session. Thank you for that. So we're going to look in a bit more close detail about how the quality of financial data can be improved. A question that we see a lot of is shareholders asking for more transparency and more detail, and that's not necessarily a negative thing. I think the only way shareholders can help at the moment is if they're given access to more financial information rather than less. So I think it's worth hearing from Mark and Alistair about how you can improve your data. I'm going to talk a little bit about the transparency side and the importance of engaging with your stakeholders. Michelle's going to explain how you need to prioritize your stakeholders when a company's stressed or distressed. And then just a little bit on good corporate governance and how to build trust and build financial reporting into your strategy. And then finally, we'll talk again about fundraisings and exits and a little bit on valuation with cash in short supply and how to engage with your stakeholders in the process to improve your chances. We have a couple of questions here from someone I know very well. Thank you for that, Fernando. For the valuations, is everyone seeing more scenarios-based assessment, including current and post circumstances, or current and post COVID-19 scenarios? Mark, Alistair, do you want to take that one?
Yes, I mean that's definitely what we're seeing. That's a fair point. As I said before, I think the scenarios, running all these scenarios, and actually as time goes on, because the process does take a while, these scenarios do evolve, and a scenario that you thought was reasonable, say a month ago, looks very different today. Because you've just got greater visibility, you know what's going on, and the same again in a month's time. So we are seeing sort of multiple scenarios being run all the time, and it's being updated, and at some point we can get to an agreement, but it does take a while.
Thank you for those, Fernando. Well, if we don't have any further questions, I think we'll wrap up there today. But do feel free, if you're going to come back and join us again on Thursday, feel free to save your questions for that second session, or if you like, our contact details are on the final slide here, and we will share those as quickly as we can with you after this, along with the recording. So do feel free to come back to any of us separately. And one final question in regards to options valuations. How has the COVID-19 impacted on the discount rates in general, in your views?
I think it's Alistair here. So I think the discount rates are they're still significant, and I think if anything they're broadened out. I mean, again, and this comes back to the alternative remuneration. You're probably going to get quite a good deal at the minute. At any point, even in normal times, you get a significant discount. But I think we are seeing more of a discount under the current times where it's needed. Still early days, I don't see anything. So quite anecdotal at the minute.
And rather, I mean, sadly, I think our experience is that the more cash-strapped companies are, the harder the negotiation will be. So again, going early, you're more likely to get a better outcome in terms of a discussion of valuation than you are when your backs are against the wall. Anyway, listen, let's leave it there. Thank you very much for attending, and a huge thank you to Mark, Alistair and Michelle for sharing your time with us today, and look forward to seeing you all again on Thursday.
Thank you.